the comprehensive analysis of DXYZ, or Destiny Tech 100.
Right.
It's positioned as this investment loophole for regular investors to get exposure to giants like SpaceX and OpenAI.
Before the IPO, which is the key.
Exactly. But it also gives these critical warnings about a pretty significant valuation gap. So let's just dive right in and see how we can maximize the analytical impact here.
Okay, let's do it.
Our first structural observation is that the discussion of the massive premium, this $3.30 to $1 valuation gap, it's just too segmented. And that diminishes its power as, the central element that really explains the price action we're seeing.
I see that. It's very clearly laid out, but the core issue, I think, is how the report isolates the market price.
Which is what, around $38?
Yeah, hovering around $38. And it puts that against the net asset value, the NAV, of $11.37.
And for anyone not deep in closed-end funds, that NAV is the real stuff. It's the underlying book value of the assets.
It's the paper value, the actual tangible value.
And that massive difference, what is it, 26, 27 bucks?
$26.63 per share.
That huge premium is held back almost entirely for the danger zone segment later in the analysis.
And by doing that, it treats the premium like it's only a risk.
Right, only a warning sign. It doesn't acknowledge that the premium itself is the reason the stock is, rocketing, as the earlier sections put it.
Precisely. The analysis report, if it wants to come across as professional, as if it's from a market participant, has to make that connection immediate.
Because that's how a trader would see it.
Exactly. When you're discussing the catalysts, the hype, the FOMO, the promise of private access, that discussion just feels incomplete.
It feels qualitative without the quantitative.
Yes, you haven't given the reader the actual measure of that hype. The math has to lead the narrative here, not follow it as a warning.
I can see what you're going for. Let's see how we can strengthen this. I think the key suggestion is to structurally integrate that valuation gap right into the explanation of why the stock is taking off.
Make it the protagonist of that section.
Yes. The price action isn't just some byproduct of enthusiasm. It is the expansion of the premium.
Fueled by the very catalysts you mentioned earlier.
It just makes the whole structure more rigorous, more logical. You connect cause and effect right there, instantly.
And that means making some concrete adjustments. You can't just leave that initial "why is it rocketing" segment as is.
You'd have to rework it.
For instance, you rework that section to explicitly connect the catalysts. Let's say, rumors of a massive new SpaceX valuation, or OpenAI's restructuring. Connect them directly to the premium swelling up.
So instead of just saying the stock caught fire,
you quantify it immediately.
You'd explicitly state that this hype is causing investors to pay, what was it? $3.30 for every single dollar of actual assets?
Yes. And that shows how the stock is moving further and further away from its intrinsic value, from that $11.37 NAV. It transforms the whole narrative.
It goes from just commentary to verifiable market mechanics.
Because that $3.30 premium is the clearest metric of investor euphoria you're going to get. If you start your discussion of the stock rocketing by defining that climb in those terms,
then the reader gets it. They get the severity and the velocity of the move in a way that just words can't convey.
You're using the quantitative evidence to explain the dynamic, not just to warn about the consequence later on.
And that simple shift in placement, it does something really crucial.
What's that?
It transforms the analysis from just, pointing out a risk to using sophisticated quantitative evidence to explain how these market dynamics are playing out in real time.
It proves the analyst understands that the premium isn't some unrelated risk factor to be tacked on at the end.
It is the price action itself.
Agreed. It builds so much credibility right from the get-go. It shows a command of the fund's mechanics.
Okay, so moving on to our second major critique. And this one is really about analytical depth. To move beyond just labeling this massive valuation gap as a hype premium, the analysis really needs to structurally define what the market thinks it's paying that extra $26.63 for.
That's a fascinating point, because the material uses that analogy of paying $38 for a wallet with $11 in it.
Which is great. It's a fantastic communication tool. Really clear.
It is, but the analysis just stops there. It attributes the whole premium to fear of missing out, to FOMO, and it avoids the tougher question.
Which is?
Which is analyzing if that premium might reflect some kind of inherent, maybe intangible value that investors are actively paying for.
And this is where we have to elevate the rigor. I mean, If we just dismiss the entire $26.63 as pure hype, are we missing something?
Like what?
Like the fact that the market might actually be valuing the scarcity of these shares, or the immediate liquidity you get, or maybe it's pricing in the massive speculative upside from SpaceX, which is what, nearly 35% of the fund?
I understand the skepticism, though. Isn't calling it hype just being honest about the extreme risk? Why overcomplicate it by suggesting it has some kind of, abstract value?
Because sophisticated analysis demands that kind of nuance. When millions of dollars are pouring into something at this valuation, you can't just call everyone irrational. You have to acknowledge their rationale.
Okay, so the suggestion is to bolster the analysis.
Exactly. Explore the specific qualitative factors that might justify at least some portion of that premium, in the eyes of the people buying it.
So we give that $26.63 gap a potential meaning, even if it's speculative. We quantify it in a different way instead of just dismissing it as irrational exuberance.
Right. That's what a pro analyst does. They don't just judge, they explain.
So how do you do that?
Well, you can explore the idea that the premium is, in effect, paying for access. DXYZ is the ticket to an exclusive club.
Okay.
You're paying for the privilege of immediate exposure to Elon Musk's SpaceX or Sam Altman's OpenAI, assets that are otherwise totally locked away from you. That access has a price. It's measurable, even if it fluctuates wildly.
So, for concrete examples, you'd maybe analyze the potential future value of owning a slice of SpaceX through this CEF structure before the IPO.
You're paying for optionality, a call option on the future.
And by structurally defining that access value, the analysis moves from a simple warning to a more nuanced assessment of speculative pricing.
Yes, and that framing, it respects the investors who are clearly choosing to buy the stock at $38.
It acknowledges their thinking.
It acknowledges the rationale. They're paying for the possibility of a massive, explosive return that an IPO might deliver, even if the risk is sky high. You're explaining the market mechanism, not just judging the behavior.
It adds a layer of empathy to the skepticism, which is a powerful combination. But we also have to talk about liquidity.
Go on.
In the private markets, selling a stake in a unicorn, even a small one, it can take months. It involves lawyers, negotiations.
It's a nightmare.
With DXYZ, you sell your fractional stake in 5 seconds on the public market. That immediate liquidity is definitely worth something.
It's worth a premium, and that's a quantifiable element of that $26.63.
It has to be.
Absolutely. Addressing liquidity and access means the analysis report is giving a deeper understanding of how investors weigh that risk of a high premium against the reward of unprecedented access and immediate tradability.
That elevates the entire piece. It goes from a strong commentary to something more like an institutional level review.
Okay, so our third and final high-level critique. This one is about making sure the portfolio analysis is comprehensive.
The whole portfolio.
Right. The intense focus on SpaceX and OpenAI, which, together they're only about 40% of the holdings, it creates a structural imbalance.
It leaves the majority of the fund's assets sort of underanalyzed.
Totally. The material makes a very strong case for exposure to SpaceX, the largest holding, and OpenAI. But then it just briefly mentions the others.
Stripe, Discord, Epic Games.
Yeah, and it just lumps them into this general others category.
And that's a mistake. It completely overlooks the need to assess the risk in the other, nearly 60% of the portfolio?
It's a classic case of focusing on the moonshots and ignoring the actual foundation of the building.
Is there a risk there? Are we overlooking something by focusing on the 2 headline companies?
Well, yeah, you might be overlooking the valuation stability or, for that matter, potential risks presented by these other huge unicorns that really form the bedrock of the net asset value.
You could think of the fund like a house. SpaceX and OpenAI are the fancy roof, the spire. They're the exciting parts that catch your eye.
Sure.
But Stripe, Discord, and Epic Games, they're the concrete foundation. And if that foundation cracks, the whole structure, including that 1137 NAV, it just collapses.
I think the material would be so much stronger if it just showed a complete view of that CEF structure.
So the suggestion is?
The suggestion is to integrate a structural mention of the specific valuation influence, or maybe the trajectory of at least one of the other major holdings.
Just to show you understand the entire asset base.
Right. And building on that, let's look at it from the perspective of how the value of, say, Stripe or Discord actually factors in to that 11.37 NAV.
Because it's a closed-end fund, the floor of that intrinsic value depends heavily on these lesser-known names holding up their private valuations.
The reader needs to know that the intrinsic value isn't just hypothetical. It's not just SpaceX's potential. It's secured by these other major non-headline companies.
So, a concrete suggestion would be to explicitly add a sentence or two detailing how the performance of the non-SpaceX OpenAI assets affects that intrinsic value floor.
For instance,
What happens if Stripe's valuation stabilizes, or if Discord has a major down round? That provides an essential defensive analysis for the NAV.
and if the hype around the two main companies dies down, the stock has to lean on that intrinsic value.
You have to show that you robustly analyze that intrinsic value.
That's a powerful point. Investors who are paying a $26 premium want some reassurance that the underlying $11 is solid. It's well supported.
And giving those other significant companies their due attention provides that.
It provides that analytical completeness and reassures the reader that the risk assessment is truly holistic.
A comprehensive analysis has to cover the whole pie, not just the two shiniest slices. By dedicating attention to the supporting assets, you prove you've done the deep work on the entire structure of the fund, not just the headlines that make it rocket.